Trump's $464 million problem, the bond that could reshape his empire, collateral, credibility, and the financial geometry behind a political empire. A billionaire is not evaluated when markets are rising, he is evaluated when someone asks him to post collateral, and in 2024, Donald Trump was asked to produce $500 million, fast, not as a fine. Not as a campaign expense, but as proof that his wealth could survive contact with reality, because courts do not accept reputation, they accept liquidity. In politics, numbers are slogans. In finance, they are verdicts. The $464 million civil fraud bond imposed on Donald Trump belongs decisively to the latter category. It does not measure popularity, ideology, or electoral strength. It measures something more prosaic and more dangerous: liquidity under pressure. For decades Mr. Trump cultivated a reputation as a master of leverage, an impresario of towers, branding licenses and balance sheet bravado. His public wealth functioned not merely as biography but as argument. It supported his claim to competence. It reinforced his political authority. It substituted for conventional experience. Yet a court-ordered collateral requirement approaching $500 million does something unusual to such narratives. It converts legend into underwriting. Suddenly the question changes. Not how rich is Donald Trump, but how liquid. The answer matters, not only for a lawsuit in New York, but for understanding the financial architecture beneath one of the most recognizable political brands in modern America. Wealth as theater, collateral as arithmetic. The mythology of billionaire politics depends on a simple intuition, that visible assets equal usable power. Towers suggest permanence. Golf courses suggest prestige. Branding suggests reach. Yet courts do not run on intuition. They run on collateral schedules. A judgment bond is not a fine. It is not a penalty payable in installments. It is a demand for immediate proof of enforceable wealth. Insurers underwriting such bonds must assume the worst-case scenario, that the appeal fails, and the liability crystallizes. They therefore ask questions political audiences rarely do. Which assets are unencumbered? Which are jointly owned? Which can be sold quickly? Which depend on valuation assumptions unlikely to survive market stress? Brand value disappears first. Minority stakes become complicated. Trophy properties receive haircuts. Liquidity shrinks faster than reputation. The result is a transformation. Wealth ceases to be narrative. It becomes documentation. The peculiar fragility of real estate empires. Real estate fortunes have a reassuring solidity. They occupy skylines. They anchor neighborhoods. They appear resistant to fashion. Yet their financial structure is less robust than their physical appearance suggests. Commercial property is typically financed through layered leverage. Equity is often thin compared to asset value. Cash flow depends on tenants, refinancing conditions, and interest rate cycles. Ownership structures are often shared across partnerships designed for tax efficiency rather than emergency liquidity. Each element enhances long-term return. Each complicates short-term mobilization. This does not make such empires fragile. It makes them slow. Speed, however, is precisely what a $500 million bond requires. A portfolio perfected for appreciation becomes awkward when asked to produce collateral on demand. Towers do not move quickly. Golf resorts move even more slowly. Licensing revenue moves not at all. Liquidity, in such circumstances, must be manufactured rather than discovered. Insurance markets as silent judges. Bond insurers occupy a curious position in modern finance. They rarely appear in headlines. They rarely speak publicly. Yet they function as quiet arbiters of credibility. When insurers hesitate before underwriting a large judgment bond, they are not expressing political views. They are expressing probability estimates. Their models incorporate valuation volatility, ownership complexity, refinancing risk, and reputational exposure. They assume adverse conditions. They price accordingly. reported reluctance to guarantee the full bond at once therefore conveyed a signal more subtle than any courtroom pronouncement. It suggested uncertainty, not about the existence of wealth, but about its usability. Markets interpret such hesitation carefully. Lenders adjust expectations. Counterparties reconsider exposure. Observers begin to distinguish between headline net worth and collateral ability. Financial reputations are rarely destroyed by a single event. They are recalibrated by signals like this: the political economy of verification. The timing of the bond requirement transformed a technical financial matter into a national spectacle. It arrived not during a quiet post-career dispute but during an election cycle. That coincidence altered its meaning. Campaigns depend on narrative clarity. Mr. Trump's narrative has long emphasized business mastery as evidence of executive competence. A liquidity test complicates that argument, not because it proves weakness, but because it introduces uncertainty. Voters may tolerate ideological controversy. They are less comfortable with ambiguity about solvency. Verification is therefore politically disruptive. Courts require documentation. Insurers need appraisals. Lenders need transparency. Each step reduces the space available for myth-making. In ordinary business disputes, such processes stay private. Here they unfolded in public view. Collateral became theater, the arithmetic of leverage compression. A $500 million bond does not necessarily threaten solvency. It threatens flexibility. Financial empires run through optionality. Owners refinance properties before maturities arrive. They pledge assets selectively. They rotate equity between ventures. They exploit valuation cycles. These maneuvers depend on unencumbered collateral. Posting a large bond reduces that freedom. Assets pledged once cannot be pledged again. Liquidity buffers shrink. Negotiating leverage weakens. Opportunities narrow. The change is subtle but cumulative. No single constraint proves decisive. Together they alter the geometry of decision-making. Leverage compression is rarely dramatic. It is incremental. Yet its consequences can be strategic. The illusion of public equity rescue. Mr. Trump's stake in Trump Media Technology Group appeared to offer an elegant solution. Public shares are visible. They are tradable. They have quoted value. In theory, they provide collateral. In practice, lenders treat volatile equities cautiously. Political associations increase risk. Concentrated ownership increases uncertainty. Lockup provisions reduce flexibility. Haircuts widen accordingly. A share price visible on television screens is not equivalent to cash in a treasury account. It is an estimate contingent on sentiment. Thus, the very asset that seemed most modern and liquid became one of the least efficient instruments available for collateralization. Visibility is not liquidity. Markets remember the distinction even when investors forget it. Transparency by compulsion. For decades Mr. Trump's wealth estimates existed in a peculiar informational zone between assertion and verification. Public filings offered partial glimpses. Media investigations provided approximations. Litigation occasionally revealed fragments. Yet the overall structure remained elusive. The bond requirement altered that equilibrium. Insurers requested documentation. Courts requested schedules. Lenders requested valuations. Each request narrowed the gap between declared wealth and measurable collateral. Transparency imposed externally differs from transparency offered voluntarily. It produces different incentives. It changes negotiating behavior. It reshapes reputational risk. Entrepreneurs accustomed to controlling their narratives rarely welcome such adjustments. Campaign finance meets credit risk. The intersection between private leverage and presidential campaigning stays unusual even by contemporary standards. Candidates normally confront policy scrutiny, donor expectations, and media pressure. Few confront $500 million collateral obligations simultaneously. Liquidity affects feeling. Donors prefer stability. Counterparties prefer certainty. Campaign strategists prefer clarity. A large bond introduces ambiguity into all three relationships. This does not prevent campaigning. It complicates messaging. Political authority depends partly on confidence projection. Financial obligations constrain projection subtly but persistently. The effect resembles a background noise rather than a headline shock. Yet background noise accumulates. In electoral politics, accumulation matters. The anatomy of a collateral event, understanding the significance of the $464 million bond requires distinguishing between three financial concepts often treated as interchangeable: net worth, liquidity, and collateral capacity. Net worth measures assets minus liabilities at estimated market values. It describes position. Liquidity measures the speed with which assets can be converted into cash without significant loss. It describes flexibility. Collateral ability measures the willingness of lenders and insurers to accept assets under adverse assumptions. It describes credibility. These metrics overlap imperfectly. A property empire may rank highly on net worth while scoring poorly on liquidity. A volatile equity stake may score highly on liquidity while scoring poorly on collateral ability. A diversified institutional portfolio may perform well on all three. Mr. Trump's financial structure appears strongest in the first category and weaker in the latter two. The bond requirement therefore precisely evaluated the dimension most exposed. Real estate and the politics of valuation. Property valuations depend on assumptions. Rental income projections. Interest rate expectations. Comparable transactions. Zoning conditions. Each factor introduces uncertainty. Courts and insurers incorporate that uncertainty differently from promoters and developers. Developers emphasize potential. Insurers emphasize the downside. The difference becomes decisive during collateral disputes. Assets valued optimistically for marketing purposes may receive conservative treatment in underwriting models. The resulting gap does not imply misrepresentation. It reflects institutional caution. Nevertheless, the gap shapes outcomes. A tower described as worth hundreds of millions in promotional materials may secure significantly less in collateral terms. The discrepancy alters borrowing ability. It alters negotiation leverage. It alters narrative confidence. Valuation is never neutral. It is contextual. The psychology of billionaire politics. Modern democratic politics has developed an unusual fascination with wealth as credential. Voters interpret financial success as evidence of competence. Candidates exploit the association. Media narratives reinforce it, yet wealth functions differently when examined by markets. Investors ask about leverage ratios. Insurers ask about liquidity buffers. Credit analysts ask about cross-default triggers. None of these questions appears on campaign posters. The $464 million bond forced them into public discussion. Such exposure is rare. It reveals the distinction between perceived strength and operational resilience. It reminds observers that reputational capital cannot substitute indefinitely for financial structure. Politics rewards projection. Finance rewards documentation. Occasionally the two collide. Collateral as narrative disruption. Narratives endure because they simplify complexity. Mr. Trump's narrative emphasized scale, visibility, and deal-making prowess. Collateral disputes emphasize ownership clarity, encumbrance status, and valuation method. The languages differ. When the second language intrudes into the first, audiences experience disorientation. Towers become spreadsheets. Branding becomes underwriting. Prestige becomes discount rates. The shift does not necessarily damage reputations. It changes expectations. A businessman who survives a collateral test appears differently perceived, not weaker, but more measurable. Measurement alters myth. The quiet power of lenders. Financial crises rarely begin with courts. They begin with lenders adjusting assumptions. Covenants tighten. Refinancing spreads widen. Collateral requirements increase. These changes occur gradually. They seldom attract attention until their cumulative effect becomes visible. The bond requirement accelerated such adjustments. Assets pledged to secure legal obligations cannot simultaneously support new borrowing. Liquidity buffers shrink accordingly. Counterparties respond. None of this implies distress. It implies constraint. Constraint rarely appears dramatic. Yet it shapes strategy, the geometry of reputational leverage. Reputation functions as collateral in politics. It signals competence. It attracts donors. It reassures supporters. Financial obligations interact with reputation subtly. They do not erase it. They recalibrate it. Mr. Trump's political identity depends partly on his status as a successful businessman. A large collateral requirement invites scrutiny of that status. Supporters interpret survival as strength. Critics interpret exposure as weakness. Markets interpret both as information. Information accumulates regardless of interpretation. Thus, the bond became more than a legal episode. It became a reputational data point. Public markets and private confidence. The presence of publicly traded Trump media shares introduced a modern twist to an otherwise traditional real estate story. Public markets run continuously. They produce visible prices. They respond quickly to sentiment. They appear liquid, yet lenders evaluate such assets differently from investors. Volatility increases haircuts. Concentration increases risk. Political association increases uncertainty. The resulting collateral value often falls far below market capitalization. This discrepancy illustrates a broader principle. Market visibility does not guarantee financial usability. Financial usability depends on stability. The structural logic of family office empires. Many property dynasties share similar characteristics. Assets concentrate geographically. Ownership structures overlap. Leverage accumulates across partnerships. Liquidity stays limited. Such systems perform well during stable conditions. They struggle during synchronized stress events. The $464 million bond did not create such stress. It revealed the possibility of it. Revelation alters expectations even when outcomes are still unchanged. Lenders reconsider exposure. Insurers reconsider pricing. Observers reconsider narratives. Financial architecture becomes visible precisely when it is evaluated. The strategic meaning of flexibility. Flexibility is the most undervalued part of wealth. Liquid investors can shift positions rapidly. Property owners cannot. Branding entrepreneurs rely on feeling. Credit markets rely on collateral. A large bond reduces flexibility without necessarily reducing wealth. The distinction matters. Wealth decides status. Flexibility decides strategy. Campaigns require strategy. Thus, the significance of the bond extended beyond courtrooms into electoral planning. Liquidity affects timing. Timing affects messaging. Messaging affects feelings. Feeling affects elections. The rare spectacle of balance sheet politics. Historically, presidential campaigns rarely intersect with personal collateral obligations at this scale. Candidates show tax returns reluctantly but routinely. They do not normally negotiate insurer guarantees simultaneously. The unusual nature of the episode explains its persistence in public discussion. Observers sensed instinctively that something different was occurring. They lacked technical vocabulary. They recognized structural importance. Nonetheless, balance sheets rarely become campaign issues. Here they did. The result was a hybrid narrative combining law, finance, and politics in equal measure. The market's understated verdict. Markets rarely issue explicit judgments about individuals. They adjust spreads. They change valuations. They alter collateral requirements. Observers must interpret these signals indirectly. The reported hesitation among insurers represented one such signal. It did not predict failure. It suggested caution. Caution is contagious. Once introduced into a financial narrative, it persists longer than headlines. Investors remember uncertainty even after events resolve. Reputation adjusts slowly. Collateral events therefore produce lingering effects disproportionate to their immediate consequences. the deeper question beneath the number. In the end, the $464 million figure functions less as a liability than as a diagnostic instrument. It reveals the structure supporting a political brand built on financial credibility. It evaluates assumptions rarely examined publicly. It invites observers to distinguish between scale and flexibility. If Mr. Trump satisfies the requirement without significant restructuring, the episode becomes procedural noise. If the requirement constrains leverage materially, it marks a subtle turning point in the evolution of his empire. Either outcome matters, not because of the money itself, but because of what the process reveals about the relationship between reputation and collateral. Markets do not ask whether someone appears wealthy. They ask whether wealth can survive stress. Politics prefers the first question, finance insists on the second.